FBN Holdings PLC, that's the holding company for First Bank of Nigeria, has appointed Nnamdi Okonkwo as its new group managing director. Okonkwo is the former managing director and chief CEO of Fidelity Bank of Nigeria PLC. His appointment followed the voluntary retirement of UK AK, who has completed his two-term tenure. AK, according to the board, tendered his notice of retirement on August the 10th. His appointment is, however, still subject to approval by the Central Bank of Nigeria and the Securities and Exchange Commission. Peter Abbey is an equities trader at Stanbic Ibtc Stockbrokers, and he joins me now for more on this and outlook on the Nigerian markets. Peter, thank you so much for coming through online. What do you make of this recent announcement at FBN Holdings, and of course the renewal of the appointment of the managing director and deputy managing director at First Bank, the commercial bank itself?
All right, thank you for having me. For us, it was a good development looking at the previous performance of Mr. Okonkwo at Fidelity Bank, and also looking at the fact that he had a good time. I mean, almost like helped to turn around the bank. So we feel this is a very good one for the bank. And considering the various performance of the bank since September, when it traded 7 naira 50 kobo and it rose to as high as 12 naira 70 kobo in October. That was about 69% gain. We feel that this momentum will be continued as Mr. Okonkwo takes over.
If we stick with the banking sector, looking at GTCO, which is the holding company for the commercial bank, which is GT Bank, we've known for years and decades. What's your reading of the third quarter earnings?
Okay, GTCO released their third quarter numbers. The numbers were fairly good. When I mean fairly good, the quarterly performance increased, though year to year, the earnings per share declined 9.6%. Well, the decline year to year, it could be largely driven, we could attribute that to the decline in interest in income and growth in operating expenses. And when we look at the positive side of the numbers, the non-interest revenue grew by 22.3%, driven by growth in e-business income. And also, the loan loss provision declined by 41% year on year. So we feel, looking at the totality of all this performance, we feel is a very fairly good one, and is a name that we like. We feel going forward into the fourth quarter, which we believe the bank will sustain its e-business revenue and also help the retail diversification strategy they have been into will also be intensified.
If we switch gear from financial services or banking into the industrial goods, give me your reading at Stanbic Ibtc Stockbrokers of Abua Cement. That's the second largest cement maker.
That was another good numbers. We saw the earnings per share increased 23%. This was on the back of strong growth in their sales, and also they were able to manage their interest expenses that declined. So on the positive side, we saw those 2 points helped the company to have that good numbers. But on the negative side, as we know, the inflationary pressure in the economy also had a toll on the administrative expenses and manufacturing cost of the business. Of course, we look at the energy, the repair, the maintenance. This skyrocketed to about 53% year on year. So in total, is a name that we like, looking at the growth they have recorded in their top line.
I'm sure you folks did not miss the Nestle's third earnings, 25 naira dividend. I'm sure you wouldn't have missed that for any chance.
Yeah, it's a good one. Though we look at the dividend yield, approximated about 2%, looking at where it's trading in the market at the moment. But on the top line, which is the revenue, it's also it's something that the company has been able to maximize in terms of pricing, maximize pricing and volume. And looking at the segments that help the company, food and beverages help the company. There was sales growth in those sectors, from Maggi to beverage, in Milo and Nescafe. So these are the names, the sectors that the segments that helped the company. But I would also like to balance it, looking at the inflationary pressure also impacted the company, just as we have seen in Abua Cement. despite the increases in prices, the gross margin contracted, and also the net finance charge also increased year on year. So, but overall, looking at the dividend, we feel the investors will like to participate, and the company has been a very good one in terms of sales. So we feel this will continue into the third quarter.
Here we are in the banking sector. If we step back a little bit, Peter, into that, with not missing out the UBA, with its Pan-African footprint and all that, you think the third quarter numbers came in quite in line with market expectations?
It's actually beats so many forecasts of the market participants. The growth, that was a growth of about 35%, which we could attribute to higher interest on loans, reduction in funding costs, and lower than expected loan loss provision. So the company did very well year-on-year basis. And also, when we look at the non-interest income, I think that is where the company has to adjust. That declined 5% year-on-year. There is a decline in their net trading income, and the operating expenses also increased about 7% year-on-year. So we feel if we net off all this, the non-interest income, which declined, and the operating expenses, which increased, but the growth in the interest income helped the company to have a good growth. It was a nice performance overall.
Okay, so do you have a buy or sell recommendation for the companies? We'll talk about but you know that if you do that on TV, you're going to be. Well, what's your outlook for the market in Q4?
The quarter is already running. What we have seen so far, block trades are dominating activities on a daily basis, and when we net that off, the market is fairly quiet. But with the rising crude oil price, which is going for about $80 per barrel now, and the increasing efforts to boost FX reserve, that's about above 40 billion at the moment. We anticipate that this will drive liquidity, and we also expect that going into the end of the year, from now to December, we expect investors will start taking position ahead of next year's full year earnings, and that means that they will want to take position to take advantage of different corporate actions, from dividend to bonus share, that will be coming on the back of the earnings.
Thank you so much, Peter, from Stanbic Ibtc Stockbrokers. Thank you so much. Enjoy the rest of your day.